let's get into it today. What I want to talk to you guys about is what we call the Wheel of Fortune strategy. The Wheel of Fortune strategy. You may have heard about this before. It's just kind of a cute nickname for something that's been around for a long time and is probably my number one go-to strategy that I can use in just about every account that's out there. So I want to give this strategy to you guys probably over the course of the next 20 minutes or so. I'm not going to belabor the point. I'm going to very quickly go through some examples of this thing and then show you how you can get some free resources if you want to pursue this strategy. All right, so the first thing I want to do to you guys is to let you know to quit buying stocks. Quit buying stocks. Retail investors buy stocks at the worst prices out there. We always do it. And part of the reason is because we chase the car, right? So I want you to think of this analogy of a dog chasing after the car. It's not going to end well, right? So chasing after runaway rallies. And there's actual psychological reasons why retail investors chase after rallies, because they can't help themselves. The actual pain of sitting on the sideline watching a rally get away without you is actually greater than taking a stop loss. On a normal trade, the pain of sitting there watching a rally, this is why we all lump in right at the end. We just can't take the pain anymore. And we finally hold our nose and jump on board. And it always ends up the same way. And we're seeing that right now. That is what we do. We chase after the car. So I don't want you guys to do that. However, so we could get into some strategies about how to use things like limit orders, right? So we can look for pullbacks. Well, that sounds easy until you actually go to do it, right? If you're trying to buy pullbacks via a limit order, let's say that you identify the price breaking high, gapping way up. In this case, this is Zoom, by the way. I took this earlier today. I don't know what's going on now. But let's say that you thought the gap was going to be closed and you have a limit order down here at about 325. Well, you're going to be the bride left at the altar there, because the price is going to come down, get close, but not fill you and take off again. So once again, you're left high and dry. So this is buying things via pullback is not necessarily very easy. If we're trying after this one, I'm kind of in the way here, but you can see if we're trying to buy down at the same lows down here, if we think it's going to be a double bottom, like it takes off from here, and we say, okay, well, maybe this is going to retest the bottom and then it takes off over here. Buying via limit order, just sitting there with a limit order good till cancel, is no guarantee that you're going to get filled. It can be very, very frustrating. So that's my question, is what if the price weren't to fall back far enough for you to fill your order? You end up chasing it. This is why we play that, the chasing after the car, is we chase the rally. We couldn't get in here at our proper price, so we end up entering right at this point up here, significantly losing a lot of edge. So that is our buying pullbacks via the limit order thing. So you can also say, well, maybe we'll just take a breakout order. We'll take the opposite of this. We'll just buy breakouts. Well, that's not that easy either. It always looks easier with the benefit of hindsight. But if we're buying this one, if we're buying this breakout here fails. This is a nice breakout here, but let's see if we buy this breakout, that one fails. That one fails. That one fails. And typically what happens is when you run 2 or 3 failed breakouts in a row, you're going to sit on the sideline and then watch this one go without you. So there's no guarantee it's going to be a valid breakout. And quite honestly, a lot of these breakouts are false breakouts. So we'll test your resolve to get on board. So these are just some of the reasons why trying to either use limit orders or, buy stop orders on breakouts, it's just difficult to get on board. So we end up getting a crappy price when we're chasing after an asset. So let's kind of mark down some of the problems that we have to solve here today. This is what we're going to fix. If we're doing pullback entries, you set your limit order too far down, you're trading scared money, you get left behind on every rally. So you get frustrated and set the next limit order very close, or maybe you even just end up chasing it. And this is precisely when the stock takes a much larger pullback and probably stops you out. We've all been there before, right? It almost seems like the market has it in for you on these pullback entries. And just when we think that's bad, we get into the breakout entries. You take the first breakout, it fails. Take the next breakout, and that one fails as well too. So you just sit there on the next one, you go, well, I'll just see what happens here. I'm just gonna wait and see what happens on this breakout. And then it takes off, of course, without you. It almost is if it has eyes, right? It's almost like it's out to get you. And there's very specific reasons why that happens. It's nothing to do with you. It's the fact that everybody else, all of your friends are probably getting the information from the same place. So there's got to be a better way to get on board assets that we want to get on board, right? So this is why I'm saying quit buying stocks in the way that you're doing. What I want you to do instead is consider using what's called the cash secured put option. Some of you may have heard of this before as a strategy called naked puts. That is not the correct term. Naked put implies that you don't have the margin nor the cash necessary to accept assignment. So this is why I use the term called cash secured put option. So you may be sitting there thinking like, what on earth is that? Well, we can get paid to buy stocks at a discount. It is a phenomenal strategy. It's one of the simplest ones in options. However, it's rarely the one that people start with. Most people start by buying call options, which is actually one of the very most difficult to win strategies out there. So most of you have heard of calls and puts before. You know, buy a put that's bearish, buy a call that's bullish. But those are long trades, and we rarely do them like that. A cash secured put is actually selling to open. We sell the put to open. Don't let that confuse you yet. Our intent is that we're going to buy the stock if the price is at or below the strike price. So what we're going to do is we have a price of the asset going like this, and we're going to look for a pullback. And what we're going to do is we're going to sell a put. We're going to sell a put option with a strike price that's below the current price, just like our limit order below the current price. And as soon as we sell that, we immediately get cash into our account. Just like magic, the cash goes straight into our account. We can do whatever we want to with it, as long as I have the cash in my account to be able to buy those shares if necessary. This is why we're calling it cash secured, right? So it's cash secured. So this may not make sense until I get to an example. So you might be saying, Doc, give me an example. All right, I hear you. So let's talk about AMD, Advanced Micro Devices. Advanced Micro Devices has been one of the stronger stocks, especially since July, breaking out of an ascending triangle pattern, going ballistic to the upside, pulling back right now. So you might be saying, I don't want to buy this at 77 a share. And that was this morning. I don't know if it's lower right now, but at 77 a share this morning. So you want to buy this at $60 a share, all the way down here. Now, if you're sitting there with a limit order, good till cancel, you may be sitting there forever waiting for that thing to come down to $60 a share. Maybe you'll get filled, maybe you won't. But if I sell a $60 put, I guarantee I'll make money with that. Guarantee I'll make money with that in some fashion. So let's say if you want to pay $60 instead, I can go out to November, which is a long way away. That's 58 days. It's quite a long time to hold something, but it gives me a long time to be able to manage this. Okay, so I can do the $60 put, and this is a per share price. So what you do is you multiply that by 100, because each contract implies 100 shares. So I'm going to get about $160 by selling one contract, $60. I'm on the hook to spend 100 shares, to buy 100 shares at $60. So what's my obligation? I've got to have $6,000 in my account. Right, it's not that cheap of a stock anymore. AMD used to be like really cheap. It was like $15, $20. It's a more expensive stock now. not a Google, not an Amazon at 3,000, but still $6,000 is your obligation. So that's not bad. If you do the math on, let's do the math really quick. So how much of a return is that? If I make $160 on 6,000 of capital, that's 2.67%. Sitting there on my rear end doing absolutely nothing for the next 58 days. This is the definition of passive income. So if the price goes higher from here, I'm not going to get filled. I'm not going to be asked to fill. I'm not going to be asked to buy the stock. If the price goes sideways from here, nothing happens. The contract expires come November. I keep that $160. Nothing happens. If the price goes down somewhat, down to 65 between now and November, nothing happens. I keep the 160. It's only if the price goes all the way down here to $60 a share or below that by November 20th that I have to do something, which may be that either close out the position, I close that out, maybe for a profit, or I decide to accept assignment and buy those shares. Either way, I keep that $160, and it helps to lower my cost basis. So what did I just do? I got paid to buy it on a pullback. I got paid to buy it at a discount. Where else can you find that? It's so simple. It seems like a trick, but it's not. It's just a very simple strategy. So you may say, show me again. This is what I did back in March. Back in March, during some of the worst days of the financial crisis that we had, the lockdown, the pandemic, on March 16th, so this is about a week before the actual bottom, I said, I'm willing to go long the S&P 500. I'm willing to go long the United States of America. I mean, this is one of the worst sell-offs that we had in 91 years, and I'm willing to go long the United States. So I'm willing to take the other side of the trade. I'm willing to be contrarian on this. So I said, I'm going to sell the 17 April $32.50 put for $575. So one contract, $575. What kind of a return is that? The capital on that was $32.50. So 575. That's a 17.7% return. Pretty phenomenal for sitting on my rear end for 30 days, right? But nobody else is willing to make that trade. So this is why you get paid well for it. So you can see the price bounced from there and my obligation expired. I did not have to buy the SSO at $32.50 a share. I mean, these are so simple to do, but they're not obvious in the middle of them, right? Nobody's obviously buying at the bottom of this, but it's better than the catch the falling knife trade. A catch the falling knife trade is if I'm just buying it here, then my P&L is going to swing up and down like massively. And in fact, I would have gone underwater first before this thing would have gone up, which would have been some sleepless nights there. But as it was, I sold out of the money puts, so I had a huge margin of safety for this. Okay, one more example. This is on gold. So this is before the crash. And I didn't get a very good entry on this. I think this is one of those where I called this out in the newsletter or the service, and then the next day came along and I got it, the market rallied and I got a crappy entry on this. But I sold the 146 put on gold, and then the market started to sell off and I got assigned. The price was at or below 146 a share for GLD on that. That was the April. No, that was the March 20. So that was like right in the middle of the, the bottoming process. Okay. I kept the $96 and then was an owner of GLD. So I got assigned. I got paid to buy GLD or gold on a pullback. So there's some examples here. Okay, so what about rules? What kind of rules do we have? This is very important. I don't want you guys to go out there and trade this tomorrow without putting some real thought to do this. Only do this on strategy, on stocks that you really want to own. I've seen people do this and try to make a swing trade out of it. and then get scared and say, oh, I might get assigned. That's the whole point. You want to get assigned. Only do this on stocks that you really want to own or assets. I'm going to talk about Bitcoin in a little bit. You got to ensure that you have enough cash to own it if assigned, and each position should not use up more than 10% of your capital. So don't do one of these where it's like one trade eats up your entire account. If that's the case, either you should be trading something smaller or wait until you have a little bit more capital. So only sell puts at a strike price that you consider to be a good buy. Never chase after these. Don't play chase the car with these as well too. So sell puts on pullbacks. So never sell puts as the price is doing this. Wait for the pullback and then sell beneath that. That gives you a margin of safety on these trades. There is no replacement for displacement. Displacement meaning the delta in price that's there. There's no replacement for displacement. The asset has got to be in an uptrend. Don't you dare sell puts on something doing this, thinking that you're going to catch the falling knife on it. It's a bad idea. Go for at least a 1% return. If it's less than a 1% return, I'm not even interested. I'm not even interested. There's other things I can do for that capital. Seek to sell puts as many times as possible to create passive income and drop your eventual cost basis. So do it once the price rallies and relieves your obligation, do it again. Do it again on the next pullback, and then do it again, and then do it again. Keep doing it. If you want to buy that stock, just keep on doing it until you keep dropping your cost basis. It's actually possible to drop your cost basis on a stock to zero. If you sell enough puts on this, if you do enough cycles and sell enough puts, you can actually make your purchase of those shares be for free. And then everything after that is gravy. Here's something that's really important. Understand your get out price before you enter. Don't try to figure that out with a live position. Map it out before you enter. That's what I call rule number 1 of risk management. Okay. Hey, Joaquin, I'll take questions after I get finished here. What I want to do is I want to finish up really quick and then let you guys go if you want to. And then I'll take questions. So those are some suggested rules for the cash secured put option. Then we move to the covered call. So what happens if we get assigned and we become stock owners? We can turn right around and sell against it. Let me ask you this. If you're a real estate owner, if you own real estate, if you own a building, especially an apartment building, it's like a given that you're going to be renting that out, isn't it? It's a given that you're going to be filling that with tenants if at all possible. You want 100% utilization. So not only do you have the asset that you're getting capital appreciation on, but you're also getting income from renting that out. That's the whole reason why real estate is such a brilliant business model. We can do this same exact thing with any asset, right? We can do this with stocks. We can do this with futures contracts. We can do this with cryptocurrency. Some of them. Any asset that you own can be rented out for the most part, if you have the ability to write options against them. So what's a covered call? It's a stock position. You got to start with a stock position that you're writing a short call option on. You're selling a call option to open that trade. So you're obligated to sell your stock. So what you do is, if the price is doing something like this, you're going to write a call option. This is the opposite. You're going to write it above the price with a specific expiration date on it. So that represents the expiration date. There's the strike price of that. And so what you're going to see is that, you hope the price stays under that strike by expiration so you can keep your stock and keep writing against it. This creates income opportunities. Again, this is a passive income. So you may say, give me an example. All right, remember the example where we got assigned on gold. I got assigned on gold or GLD right there on this day. The following Monday, the price gaps up and I say, okay, I'm going to write the 173 strike, which is like way up here. It was like way up here. That's the expiration date. because the volatility was just massive back then. So I sold this for $1.90, which was big because the price, the implied move was really, really big. So I was able to sell it above the range of where the price goes, and it just expired about 30 days later. So we sold this on 324 and it expired on 420. I did nothing. I did nothing. Since the price never got to above the 173 level by the April expiration, which is right there, we kept the $190 credit in our shares, earning 1.3% in the month. So as long as the price didn't go up to, if this is 173, as long as the price did not get up to or exceed 173 on that expiration date, which is 420, then we keep the stock and we just keep writing against it again. We just keep writing against it. That's a covered call. So let's talk about some rules for the covered call. There's really two ways to do this. Now, myself, when I get assigned on the stock, I'm happier if I can go back to writing puts again. So what I'm going to do is maybe write a couple of cycles against it, and then I'm going to allow myself to get called out. I'm going to allow that stock to be taken away from me because I'm more comfortable just writing puts. It's easier. It's easier to do. But if this is perhaps this is some set of stock shares that was willed to you, or you've had, like Apple shares since they were $5 and you can't sell them. It's one of those things that you think you're going to have forever. Then you can play this very conservatively and make sure that you don't get called out. So I'll typically sell the short calls into rallies. So if there's a rally like this, I'll sell the short call into the rally and then watch it fade back down for expiration. At least that's the idea. You got to either close the old short calls to write new ones. You have to wait till the old ones expire, and then you can do it again. But again, you have to determine your get out level ahead of time. You can't do this on the fly. Can't do this on the fly. Okay, that's the covered call. So let's wrap things up. The Wheel of Fortune is simply taking your cash and then selling puts against an asset again and again and again and again. And eventually, if you do this right, eventually you will be assigned. You get enough of a pullback and the price is going to be at or below that strike price. You get assigned. Boom, you're the winner. You now own a bunch of shares. So as soon as you own that bunch of shares, you're going to turn right around and sell calls against them. Sell calls, sell calls, sell calls until you get called out. You're back to cash. What do? You go right back into selling puts again. So this is a marvelous passive income strategy. It takes very little time. Honestly, this is quite honestly one of these like 5 minutes a week kind of strategies. You really have to spend, once you design it, just let it go. Let it do its thing. Set up the trade. It takes 5 minutes to set up the trade. It takes less than that to manage it on a weekly basis. This is the Wheel of Fortune. This is the classic make money while you sleep passive income. It's the simplest strategy out there. It's one of the very first ones that I learned, and it is the most effective. It is the most effective that I've seen. Okay? So how do you get started with something like this? First of all, do so slowly and systematically, because you can get hurt if you do this the wrong way. You can get in trouble if you do this the wrong way. Don't let anybody tell you that you can't get destroyed doing the Wheel of Fortune. You can't. Just like anything else, no risk it, no biscuit. Capital. It's difficult to do with less than $5,000. Even $5,000 is going to be a bit of a struggle, because you're going to have to find something. Even $50 a share is going to eat up your entire account trading something like that. So you're going to have to find something lower price. You're going to have to find something decent lower price that you can do the Wheel of Fortune on. Remember, I said 10% of your account. So again, $5,000 is going to be difficult to do. The more capital you have, the easier this is. So the price of the stocks that you want to have a trade has a huge bearing on what you can afford to do. Crypto might just be the most affordable way to play this strategy due to the way that you can get micro contracts. Now, it's also important what broker that you use for this, because you've got to have a broker that offers physical settlement. Physical settlement. If you have somebody that does cash settlement like Deribit, can't really do this. I mean, you can, but they won't settle you in the same manner. They'll do cash settlement. They'll just reach in and take money out of your account if the price settles below or in the money, which is not ideal for the Wheel of Fortune. So something like, for those of you in the States, you can do Ledger X with crypto, and they do physical settlement. So capital is very important. This is not a small account strategy. I recommend that you don't do more than one asset to begin. I think that you ought to find your one thing. You ought to find one asset and just do it continuously. Can do it continuously until you get really good at this. And then once you build up enough capital, then you can start to branch out and maybe go to 2, maybe 3. But don't completely overload your account with all kinds of crap out there, because it tends to be highly correlated and it will dump all at the same time. So that's not what you want. Trade just one asset to begin. Risk management is extremely important. Know the exact price at which you no longer want to own that stock or asset. Do this before you enter. Don't try to figure this out while you're in the middle of the trade. You cannot do it. The human brain will turn into your dinosaur brain when you put risk into it, and you'll make the wrong decision at the wrong time. This is an unlimited strategy, or unlimited risk strategy. What that means is that the profit curve looks like this. You know, generally there's some kind of cap to the upside, but there's no cap to the downside. That means if this thing goes to zero, it goes to zero, you sink with the ship. Congratulations, Captain. So you've got to determine at what point you say that's enough. If it drops below this level. So this is actually a good environment to do this in. We have a very choppy market environment. We're going into corrective right now. It hasn't pulled into a full bear. It's in corrective. We have elevated implied volatility. We can sell well below the money right now. This offers a pretty good edge for what we want to do. This is a great environment for the Wheel of Fortune. Just a word about brokers. You should be able to do this on any broker that offers options. I run this strategy on margin, IRA, SEP accounts. You can do this on just about anything. I don't care what anybody says. The problem is, though, that some people are not allowed to do cash secured puts. So even though it's exactly the same trade as a covered call synthetically, a lot of times they don't let them do cash secured puts. And so you may have to ask for that. If they don't give it to you, then say bye-bye. Fire at your broker. Don't be afraid to go to a different broker if they don't allow you to trade in the manner in which you'd like to trade. It is almost impossible to get reclassified. Once they brand you on the forehead with the newbie, then they will, it takes an act of God to get you to be reclassified. Been through this before. So don't be afraid to ask for what you want at the very, very beginning of your relationship with the broker. Okay? That's how to get started. I hope I've answered most of your questions about this. I'll get into your, I see I got a couple of questions in the chat room, and I'll take some more. Now, if you need some help on this, if this is the first time you've heard about this, we're doing something a little bit extraordinary here. We're going to give you free access to our strategy course for the wheel at Ready, Set, Trade. And we're going to give it to you for free for the next 24 hours. And then after that, it's going to be $49. So all you got to do is just go to elite.readyset.trade. It's free until tomorrow. It's free until tomorrow. Just go in there and sign up, and you can get right into the class. We're not going to hold anything back from you. If you have any questions about it, you can contact me, doc@readyset.trade. So go ahead, and if you go into elite.readysettrade, what you'll do is if you'll scroll down the page, you'll see it says choose a membership plan. And then the one on the right, this is the one that you want to pick. unless you just want to join us and get everything. But just go ahead and get that for free. And that's the wheel trade. So I hope I answered your questions. I've tried to provide some value for you guys today. Doesn't cost anything. We're trying to be here for you guys. This is tough volatility to deal with. This is tough market to learn from, right? Especially those of you that jumped on the end of the rally. You're like, what the hell is going on now? So we're here for you guys. Learn how to trade options. Really, if you get started in stock or just spot crypto or something like that, eventually you're going to want to learn to trade options. And it's not that hard. It's not that hard, especially if you focus on simple strategies. Get good at one thing at a time. You don't have to get into all these crazy different, broken wing butterflies and different strategies like that. You can just keep it simple with a wheel strategy. You can do very, very well. All right, everybody. Thanks for joining me here today. Adios. You guys take care now.